Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I am here with you with the market wrap-up for the week of May 22nd through May 26th, 2023. Here's the game plan, what I'm going to show you today. We're going to take a look at the SPY and the QQQs, and we'll take a look at their performance for the last week, and then we'll also look at them for the last rolling month as we define that, basically the last 4 to 5 weeks. So that's the plan for the major market indexes. We'll then break it down in terms of the 13 leading sectors. And again, we'll look at those in the context of the past week, the week that just passed. And then we'll also again look at that in the context of the rolling month. And so we'll take a look at the financials and materials and all 13 of those major market industrial sectors. We'll then take a look at the major market indexes, and we'll go to the live charts, and we will take a look at where there are potential key trading levels, both above and below current price. At PTL, we look at what are referred to as supply and demand levels. Demand levels being places where there was prior trading and there is an expectation of future upward price pressure. Supply levels are places where price got swatted down, where the supply and demand equation went out of balance. And at that point, there is the expectation that there is still a residual downward price pressure in those areas. And so when price returns to those areas, we'll expect to see a drop from those areas. So we'll take a look and see where we see some levels for both the SPY and the Qs. And then lastly, we'll look for some of those levels in various other symbols that are popular. So we'll take a look at some of the FANG stocks, or really MANG stocks at this point, now that Facebook is Meta. And then we'll also take a look at a couple of other symbols as well, including Tesla. So that's the game plan here. Before we go on, obviously the ubiquitous disclaimer, Precision Trading Labs, we are not financial advisors, we are not fiduciaries, we are not broker-dealers. Everything that we present here is, of course, for educational purposes and informational purposes only. So let's take a look at the wrap-up for the week prior, and we'll go from there. So here is a percent change chart for the major market indexes. So right here, here's the last day of the week that just concluded, May 26th. Right here is the prior Friday. So this is where our percent change originates from. That's what we refer to as the reference date. Okay, so this is a percent change chart. So we can see that the Qs were up about 3.5% in the previous week, and the SPY and the Russell 2000 were pretty close to flat, as well as the TLT, which is the bond, which is essentially what most people take a look used to represent what the bond market looks like. And so the bonds were relatively flat for the prior week. Okay, if we go back prior weeks, we'll see that really the Qs have been the star for the last, let's say, 3, 4, 5 weeks. Here are the historical slides here for the previous weeks. And so we can see right there, of course, there were the Qs here. They were up about 3.5% the prior week. The SPY and the Russell were actually up, a reasonable amount as well, but the Qs again outpaced the other two. And then if we continue to go back here again, this was a very tight week here, but nonetheless, the Qs were on top there again. And if we go back again, yet again, the Qs are there. Okay, and so essentially we can see that the Qs have essentially been the stars for the last month. Okay, and then lastly, there's that prior week even before. Okay, so we can see the Qs have been consistently on top. If we look at it from the perspective of the rolling month, okay, and now we actually break it down into the sectors. In fact, actually, let's just take a look at the last week before we get into the rolling month here. So here's what the last week looked like from the perspective of the sectors here. And we can see, of course, that the XLK as a sector was on top. And of course, if you know anything about the sector ETFs, the XLK, of course, are the tech stocks, and more or less that chart of the XLKs will more or less resemble the QQQs. The Qs, of course, are very tech heavy, obviously by its definition. The XLK, of course, is tech heavy. And so as a result, their charts will often look very, very much alike. And even if they are not quite identical, as the expression goes, they rhyme. So really, in fact, a lot of times people will, if they don't like to trade options, but they want to trade the tech sector, the shares of the XLK are significantly less than the shares of the Qs. So if you don't want to trade the Qs, you more or less can trade the XLKs and really pretty much do the same thing. So we can see clearly that the XLKs outpaced the other sectors. Okay, on the weak side, and these were all down last week, anywhere from about 2 to 2.5 to about 3.5%. You see the utilities, healthcare, materials, and consumer staples, and then in the middle here, these are all the other remaining sectors. Of note, we have retail in here. Frankly, this is about the strongest showing that retail is making into the bottom of the middle here. Retail has been actually very weak, driven by sort of a lack of consumer confidence, anxiety, and of course, rampant inflation. Inflation seems to be getting under control, but it's one thing for inflation to get under control. It's another thing for prices to actually then start to roll back, and that's a more difficult task. So retail has basically been pretty weak for the last bunch of weeks here. Communications has actually generally been very strong as well, along with tech, and of course, to some degree, they do in some ways go hand in hand. There is obviously a huge technology component to communications. So comm has basically been pretty strong. Okay, so that was the last rolling week, and then if we go back to and in fact, this is the prior week here, and again, we can see that the XLKs we're pretty much on top there again. And so that was the last week. And then if we go to the rolling month here, we can see here that technology and communications, as I said earlier, those were certainly the two stars here for the last rolling month. Technology has been up about 11.5%. Communications has been up about 7.5%. And then, kind of at the bottom of the upper tier there were the consumer discretionaries. And then down here, energy has actually been quite weak for the last several weeks. At one point, it was a star into, let's say, through I guess approximately about 8 to 10 weeks ago. There was in the beginning of March, there was a surprise announcement from OPEC that they were going to curtail production. That drove energy prices up, and so and then leading into that. The XLE was a star, and then pretty much for the last, let's say, 8 weeks or so, it's been kind of on the downtrend, and so we can see here this is down here, and it's been joined recently by the utilities. As I said before, retail has been very weak as well. So you can see though all of these down here are kind of really more or less clustered here. The range on here, with the exception of the very weak ones here. But these are all down, anywhere from 1% down to real estate, which is down about 4%. So we can see more or less, in terms of what's been holding the market up for the last 3 weeks, or the last, rolling month. It's really these 3 sectors. Okay, everything else is below the zero line here. So it's a kind of a very unbalanced market, and essentially market breadth is in a sense kind of weak if you look at it from the perspective of a sector view. So what do we do with all this? And I'll show you the live charts in a minute here. But essentially what we do is we look for pullbacks in some of these very strong stocks here, and we look for pullbacks in lower time frames in order to essentially leg into bullish trades, to sort of leg into the uptrend that they are generally in. And again, we look for a pullback in a short-term time frame. So if we, let's say something is an uptrend in the daily chart, we will look at something, let's say in a 2-hour or a 1-hour or a 30-minute chart, to simply look for some sort of pullback into a quality demand zone in order to then get into a bullish position. And of course, that can be expressed in any number of ways. One can, of course, buy the shares or, and of course, get into any number of bullish options positions. The simplest, of course, being either just buying a call or buying a bull call vertical spread, where you buy one call and then you sell another call above. That reduces the price of the spread position and also changes the dynamics of the options Greeks. It makes it essentially a less responsive, gentler trade, but nonetheless, it is a trade that's predicated on a bullish outlook. And that bullish outlook, again, is based on the fact that price is hopefully bouncing from a quality demand zone that I'll show you in a second here. So that's the game plan for that. And then, of course, for the weak stocks, it's the exact reverse. We will look for qualified supply zones, which are areas of expected downward price pressure when price returns to those supply zones. And then at that point, we can express a bearish trade out of that. And of course, the simple way to express the bearish trade, of course, is to short the stock. But if not, then one could, of course, then buy a put or buy a bear call, sell a bear call vertical spread for a credit. And that's another way of expressing a trade. And then, of course, one could, of course, buy also a bear put vertical spread. And that, of course, would be a debit. So those are all different ways of expressing the same, expressing a bearish trade out of the same qualified supply zone. Okay, so that's what we can kind of do with that, and that's the general approach that we take coming out of these sector analysis charts. All right, so let's take a look at the live charts here, and then we'll get a better illustration of some of the things that I was just referring to here. So if we go back here, here is the SPY, and we blow that up here. And so, as an example here, if we go back in time here, and we actually go back to this region right here, this was an area back in September where price came up, and then notice price really dropped precipitously from there. There was basically, this was a pivot here, but if we actually broke this down into a 2-hour chart, in fact, here's the 2-hour chart, we can see that price came up here and then precipitously dropped out of here. And so price was in here for a very, very short amount of time, really, less than a day, and then dropped precipitously here. And the expectation was when price returned here, not everybody that really wanted to buy got the chance to. And so at that point, essentially what happened is we had an exhaustion of buyers here. Buyers essentially backed down the price chart. And in order for these trades to occur, essentially sellers had to run down the price chart until they found willing buyers at lower prices. The expectation was when price came back to that level, you would then see another round of selling, because essentially what you had was you had supply left at this level, but there was no demand. Okay, and so when price returned here, there was a presumption that there was still some supply left because price spent a very, very limited amount of time here, and so the supply never really got chewed up. And so as a result, when price returned, we had the expectation that there was essentially untapped downward price pressure here, and that would be the opportunity to actually then express a bearish trade when price returns to that level. And if we then flash forward now from this level right here, and we go forward here, okay. And in fact, we were using right here. In fact, that was an example of one. And then this was another supply zone here. And if we go back now and we go forward in time here, you can see price came back to this level. Okay, it dropped out of that. Okay, and so that was a successful bearish trade there. Okay, and then if we come back here again, we can see that there was another return to that level yet another time. Okay, and that was a bearish trade here. Similarly, right here, this was an area of upward price pressure, of expected upward price pressure. Price came up, consolidated there. Okay, notice that we had a very bullish candle here, a gap, and then price rocketed out of there from there. Okay, At that point, then we expected that when price returned here, there would be a repeat of some semblance of a repeat of this price behavior. And you can see price came back here, bounced out of it, okay, went right up to the supply zone that I just showed you there, and then came back here, bounced again, okay? And so these were good examples of price essentially kind of oscillating, kind of ping-ponging between supply and demand. Now, does it always work this neatly? Does it always work out as perfectly as the theory suggests it should? Of course it doesn't. This is trading. Trading is all about probabilities, and so of course, when we're looking at all of this, any trades that we have are rooted in risk management. So when we were going to express the bullish trades from this zone, there was of course a stop that sat very closely, relatively closely behind this demand zone there, and so that put our risk management in here. Okay, so if we were when we were trading the SPY, essentially our trade looked something along the lines of like this, where we would have an entry at that point. Our stop would sit around a bit below this zone right here. And then this essentially represents a one-to-one trade. Okay, this is essentially our unit of risk. So we would have a one-to-one trade here, a two-to-one trade there, a three-to-one trade there, et cetera. Okay, and so that's essentially how we kind of construct our trades here. If we now flash forward to where we are today, here's where current price is. Price has now gone through and has been back to this 2-hour level here, and it's been back here any number of times here. The theory is the more it goes back there, the weaker it gets. It's almost like taking a sledgehammer and then putting it against the cement wall. Every time you kind of swing at it, it kind of weakens the region, because essentially what it's doing is it's chewing up the supply here. And so unusually, it's actually held longer than normally this one would expect it to hold. But after all of these returns to this level, and we can see there was one before that, okay, there was a return there. You can see it went back here again. It, pierced the level. It held barely and then dropped here again. So now we're back here again, and it's sitting at the top of the level. I fully expect that that's going to break. Okay. Now the thing is, though, when it breaks to the upside, though, there is another supply zone sitting immediately above here, and that's right here. We have a drop, a base, a drop there. There was there was the massive gap there. Obviously, that gap has been mostly filled from there, and then I think some little subsequent price action. There was. See here, yeah, and in fact, the gap has essentially been just about all filled. So there's a little remaining gap to fill there, but then there's a supply zone immediately above, and we can see that's barely 0.25% above. Okay, so there's going to be some definite downward price pressure when price comes up. Now, having said that, though, tomorrow when the market opens, this could actually be an exception, because of the fact that it looks like there is a draft budget ceiling deal in Congress. Biden and McCarthy apparently got together, and so somehow, by some miracle, there might actually be a deal that's not going to torpedo our credit. Obviously, until everything gets signed, it's not a definite. But there could be some major there is likely going to be some major optimism in the market tomorrow. So it's quite possible that this nearby supply zone, in fact, may actually not hold. Okay, this is a 2-hour zone, and so then the next one that really would sort of have a chance of holding, if you do get kind of a relief rally about the potential budget ceiling, the debt ceiling deal, is then up here. This is a daily supply zone here. This is a 2-hour. This is one that actually resolves nicely in the daily chart here. And we take a quick look at that. There is that level right there. Okay, so price rallied, okay, based, drops from there. Okay, so this is an area of a potential downward price pressure. Okay, and you can also see this level of downward price pressure, this supply zone, That's also sitting right here. That jagged blue line there, that actually represents the 52-week high, the rolling 52-week high. So that obviously goes back to May of 2022. And so, okay, so again, if there is a debt ceiling relief rally tomorrow, it's quite possible that this 2-hour level is going to break. But then this will be the area that we would expect. Wouldn't necessarily automatically send price hurtling down, but this will definitely be some pushback. So we'll be watching that there. So that's about 1.5% of the way from current price. So it's quite possible if you have a relief rally tomorrow and if it breaks this 2-hour zone, you could have then price kind of drill into this. And it could go a good way in, but again, I would expect that you're going to see this thing is at least going to hold things down a bit. So we'll see what happens with that. Underneath here, in terms of where the next quality demand zone is, it's really kind of where it came from here in the 2-hour chart. Okay, normally we're not fans of repeat trades going back to a zone. But having said that, both of these, the price came down and just barely kissed these zones, kissed this zone here. So it's quite possible when price returns here again, you could see another bounce from here. So this is approximately 4% down. And then in terms of really what sort of a really quality demand zone is, this one's about 6% down. So there is, kind of a little space here in between. So that's what we're looking at here on the SPY. Okay, and so here's just a little summary again. So here's the demand zone. So again, this is an area of expected upward price pressure. Okay, it's created by a period of consolidation. Okay, then right here we have an exhaustion of sellers here. Okay, the sellers essentially disappeared right here very rapidly. Okay, after that period of consolidation. So essentially the supply and demand equation went out of balance. At this point, you only had demand here, no supply. Again, the buyers essentially had to run up the price chart until they encountered willing sellers. Okay, so that's the narrative there. Okay, and again, as I said earlier, what we end up doing is looking for a pullback to these zones in order to then express a long trade. Okay, so that's the story with the SPY. If we take a look at the Qs here, here's what that looks like. So let me spread this out a bit. So on the Qs, if we go back, often as one would expect a lot, oftentimes the charts look somewhat alike. So this is that zone that we were showing you here earlier. That was essentially in the SPY. This is that level in the Qs. The one difference, of course, though, is that we don't have, you're not seeing that 52-week high. Okay, and the reason you don't see that 52-week high is because it actually the Qs are actually it actually hit that over here. Okay, that little cross there. So that was just a brand new 52-week high. Okay, so this is sitting there, but then again, where those these zones are. This preceded the last year, so that's why this is not included in the 52-week high. This was just before. This is about 13 months ago. So again, if we have that relief rally, it's quite possible this level might not hold, but the level up there might, or I should say, it would be much more likely. Okay, so where we are now is this level right here is about 1% up. Okay, and then the level that's further up, that's about 4%. So that's from current price. So this is obviously 3% beyond this level. Okay, so that's where we are on the supply side. Okay, and then on the demand side here, the first quality demand zone in the 2-hour chart, that's about 6% down, and then we have something that's basically sitting here. That's about 6, a little less than 7, and then this down here, this is about a little less than 9. Okay, so this is where our potential trading zones are for the Qs. Okay, and then if we go to some of the specific stock symbols here, take a look at Apple. So here's Apple. Right here, okay, here was a supply zone here again. There was a rally price based here and then dropped from there. And then if we go back now, okay, that occurred last summer in August of 2022. Now, if we go back here, we can see price got back here about 2 weeks ago. Okay, this is what I was looking at here about on 2 videos ago on the 12th, and we can see price has essentially more or less been battling within this level for the better part of about 3 weeks or so. So right now it's sitting again at the top of this level. It's quite likely that it's not going to hold here after repeated kind of beating up and chewing up of supply here. But we'll see what happens. So that's where we are on the supply side there. The next qualified supply zone is sitting about 2% above. Okay, and that's this region right here. Okay, and right in here there was a 2-hour level. Okay, so and if you can see those overlapping wicks, there's a 2-hour zone in here. Price came up, it dropped from there. We've now been back there again. Okay. It's quite possible, you know, obviously this is a less probable trade because of the fact, again, every time price goes back to the region, it's a little less likely to hold. Having said that, this was only minor contact here, so that's probably a reasonable chance that level will then act as a springboard for a bearish trade here. Okay, but that's about 2% higher, and then below. Over here, we kind of have these 2 adjoining rallies and 2 adjoining levels here. These are basically 2-hour zones here. And that's about 5% down. And then right here, there was this drop, base, and a rally there. And that's about 8% down. Okay. So these would be potential levels that we would be looking at to provide kind of what you can think of as support. But really, again, these are these demand zones there, where essentially we're expecting that there is upward price pressure that's waiting to be tapped. And then we can express a bullish trade out of there. If we take a look at Amazon, okay, here's where we are on Amazon. There is above here a supply zone about a little less than 5% up. Okay, here are some buy points below. Again, a rally, a base, and a rally here. Okay, if we look on this pullback, this is about 7% down, okay, going from about 120 down to about 112. So we would obviously need about a $7 pullback to get to this region. So this would be a demand zone right here. And then right here, below that, there is another demand zone that's about 5% further down from here. And so that's a little less than 12% down from current price there. And again, right here, we have a rally, a base, and then a rally. There's a large gap, a major gap there, and then a very, very bullish candle. So this is all indicative of price, supply and demand being in balance. And then it goes out of balance here. And the expectation again was when price returns to either this level or this level, you're then going to see you'll see essentially a bullish move out of those levels. And of course, as always, when we set up a trade, of course, there will naturally be a risk management plan in place. And so again, as I showed you before, I think on the SPY chart, you would have an entry somewhere around there. You would then have a stop that would sit roughly about there. And then again, if that's your unit of risk, that's a 1-to-1 trade, that's a 2-to-1 trade, that's a 3-to-1 trade. Okay. So again, that's all, you know, how we kind of construct these things. If we take a look at Google. Okay, so here's where we are with Google. Again, there's current price. On the 2-hour chart, there's a level that's about 4% down. Okay, this is a daily demand zone right here. This is about 6% down. Above here, and again, there's its 52-week high. Those blue crosses there. That's a 52-week high here, and so we can see that we're about 3.5% away from this zone here. And this is a 2-hour chart. If I turn this into the 2-hour for a second, let's move that, convert that over here, and then we go back. Okay, we can now clearly see price drop there. There's a consolidation there. Okay, and then notice bearish candle, bearish candle, bearish candle, very bearish candle. Okay, there's that steady shot down after a very brief amount of time in that region. Okay, so this is a supply zone, and we expect to see some future downward price pressure there in order to express some kind of bearish trade when price reaches there. Okay, so again, in terms of where we are with respect to of where we are, this is approximately that line was in the wrong place there. So that is about 1.5, a little less than 2% away from current price there. And then after that, the next quality supply zone is way away at about almost 13%. Okay, so that's the story with Google. Let's take a look at Facebook, Meta. Okay, so right here, this was an area. This was kind of a weak demand zone there. In fact, it actually did work, pulled back to it. However, this is something we didn't trade because this was really just a one and done pop out of here. We always want to see some follow through. So we certainly did not anticipate and get this trade out of it. Nonetheless, we can see that it certainly did work though. Again, it's up. This is above its 52-week high there. There's the blue cross. So where we are now, here's that region again, 5.5% down. Not enthusiastic about that at all. And so really the next quality zone is really there. And that's a good 10% down. So in the short term, at least on a pullback basis, we don't really see anything on Meta. The interesting thing on Meta, though, if we go back, we can actually see right in here, there's a massive, massive gap in here. Okay, okay, and that has not been filled at all. Okay, well, I should say barely. So we can see it started to fill it there. Okay, but there's a lot of gap filled to fill there. Consequently, if you get a relief rally and Meta starts to move, this could actually take a trip here, because again you've got a massive gap that needs to get filled there, and if the market ignites, this will certainly probably be right at the head of the pack when that happens. Okay, so that's the story with Meta. Like I said, the nearest demand zone of quality basis is down here in the daily chart. That's about 10% down. That's right here. This is a drop, base, and a rally there. In fact, this is almost a weekly zone. If we turn this into a weekly chart, we might actually see a weekly zone depending on how the calendar laid out there. Okay, but anyway, but this is a good zone down there. If it turned out you had a pullback and it drove through here. Okay, so that's the story with Meta. We take a look at Netflix here. Here are where our zones are. Netflix, we can see there's a supply zone there, about a little less than 13% of the way up. If we now go back in time here. Okay, again, this is something that would resolve in a 2-hour chart. Okay, so this is, and we can see that's a good distance up. Over here, okay, this was an area where there was supply here, which is really now what one could think of that it was really more resistance at this point. It's certainly not supply anymore, at least for our purposes. And if we go forward now, we would really not be looking to trade this. Excuse me, we have the sounds of the city behind me here. Price has been back here now numerous times. Price is kind of driven through here. You can almost think of this as sort of a triple top here. The expectation is when price comes here, it's most likely that whatever supply was in here has been chewed up, and consequently, we would not be looking to short out of this region. Up here, you can see this was just a kind of a series of just rejections out of this zone right here. Again, I would not be looking to trade this. Some people would characterize this as resistance over here. We'll certainly keep an eye on it, but for our purposes, really what we would be looking for to short would be out of here. So we're not racing to short Netflix anytime soon. Right here, though, if we look below, On the 2-minute chart, oh, excuse me, on the 2-hour chart, we can see over here that price rallied here. Okay. Then it based. You can see that green candle, that little red one there. Then there's that gap and go there. So when price comes back, we would expect to see a bounce out of here. But that's a good 10% down then. Okay. In here, there are some lower time frame demand zones there, but now we're getting into sort of the lower time frames. And we certainly look at these with our subscribers on an intraday basis. But in terms of swing trading, we really don't see anything there. And then lastly, we'll take a look at our buddy Elon and Tesla. And so here's where we are on current price here. And so right here, we have a drop, a base, and a rally there. Price has not been back there since. So if we look down here, though, this is about 13% down. So that's a good ways down. The thing is, what we will take a look at, though, is this region right here. Okay, there's a drop, a base, and a rally there. I would probably end up having to drop this down into a 60-minute chart. So, again, I'm really not a huge fan, of trading the lower time frames, particularly on swing trades. But really, I think there might be something reasonable that one could probably trade, probably in that region right there. So at that point, then this is conceivably a demand zone that we might take a look at. Okay, and so we can see right here, and if we just kind of throw a quick line in here, there, we can see that is. Let's see where are we here? That's about 4% down from current price. So we'll take a look at that. So at any rate, there you go. There is our market wrap up for the week ending May 26th. I hope you found it interesting. Hope you found it helpful. If you did, please give us a like on our YouTube channel. Please subscribe to it. And then also you'll see a schedule a call link. You can click on that and speak to either myself or my partner, Ryan Nocera. We'd be happy to tell you more about Precision Trading Labs, talk to you about the whole supply and demand concept, and of course, review a couple of charts that might be of interest to you. So, come to us bearing symbols. All right. So at any rate, there you have it. Again, this is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and I will see you next time. Take care.